Have you ever looked at your financial statements or maybe your retirement plan documents and just felt like you're trying to read a map to some hidden treasure, but it's written in a language you only kind of understand? All those terms like AGI, elective deferrals, qualified dividends, it can really feel like this dense financial jungle. And you need to plan for retirement, right? You know your investments should be working smarter for you, but then taxes enter the picture. Yeah, that's where I think a lot of us feel truly lost. Well, if that sounds familiar, you are in exactly the right place. Welcome to the deep dive. Our mission here is simple. We cut through that very complexity. We've plunged into some really authoritative sources straight from the IRS, actually. We're talking publications like 560, 590A, 590B, and 550. Our goal for you today is to distill the most important nuggets of knowledge, the key insights, really, give you a shortcut to being genuinely well-informed on U.S. tax issues around retirement planning and investment income. And yeah, we'll try to uncover some surprising facts, maybe add just enough humor to keep you hooked along the way. And so today, we're tackling two critical questions that can, frankly, profoundly shape your financial future. First, how do you navigate all those different retirement plan options to choose the right one for your specific situation? Understanding, the tax advantages and the potential downsides. And second, how do you calculate the true return on your investments? Not just the flashy gross numbers, but what you actually keep after taxes bite. This isn't just theory. It's about empowering you, helping you make smarter, more strategic decisions for your financial well-being, helping you chart that course through the jungle.
Yeah, and what's really compelling about this, I think, is just how interconnected all these decisions are. Every choice you make, from how your income is defined for making contributions to which account types you pick to maybe defer or even exempt taxes, and then how different kinds of investment income get treated. It all builds into this one cohesive financial picture. It's really about optimizing every single step of your financial journey, turning those raw numbers into something meaningful, something actionable.
Couldn't agree more. It's about the whole picture, definitely. So, what awaits us in this deep dive? We're going to unpack the various types of retirement accounts, reveal their unique tax benefits, maybe point out some potential traps. Then we'll pull back the curtain on how different investments are taxed. We'll show you why that net of tax impact is really the only true measure of success. Consider us your expert guides on this little expedition. Okay, let's unpack this.
Navigating retirement plans. A tax-savvy approach.
Okay, let's start right at the very beginning of the retirement savings journey. And that often means understanding what exactly counts as compensation. Because this isn't just some, accounting detail. It's the foundation, the bedrock upon which all your contributions to retirement plans are built, especially if you're navigating the waters of, say, small business or self-employment. So for the IRS, what exactly is compensation in this context?
That's, a really fundamental starting point. For IRS purposes, compensation, broadly speaking, refers to the payments you receive for personal services. So this includes the straightforward stuff like your regular wages and salaries, but it also extends to things like fees you might earn for professional services, commissions, tips, even the value of certain fringe benefits your employer provides. Think the taxable part of group term life insurance. Essentially, it's pretty much any income you get for work you perform as an employee.
Okay, so that sounds pretty broad for employees, but what if I'm an entrepreneur? Running my own business, self-employed. Does that definition still apply directly, or are there specific nuances I need to know? I imagine that's where it might get a bit tricky.
That's a great question, and yes, absolutely. There's a crucial distinction for the self-employed. For you, compensation specifically means your earned income from your trade or business. Now, this isn't just your gross revenue, it's your gross income minus all your allowable business deductions. And here's a detail that often surprises people. It also includes the deductible portion of your self-employment tax. So your net earnings from self-employment, after you make those specific adjustments, that's the figure you use to figure out your contribution limits. And a key point here, if your self-employment results in a net loss for the year, well, you absolutely cannot make personal contributions for yourself to a retirement plan for that year. It directly links your ability to save for retirement to how profitable your business is. And that has immediate cash flow implications, obviously, for business owners trying to maximize their contributions.
That makes perfect sense. No profit, no personal retirement contribution. It's a direct link. Okay. But what about the money that an employee, say, chooses to put aside into plans like 401ks or simple IRAs? How is that treated from a tax perspective? Like right off the bat, this is where we start seeing some of those immediate tax advantages, right?
Precisely, yeah. Amounts that an employee elects to defer into various qualified plans. You mentioned 401k, also 403bs, simple IRAs, SAR-SEPs, which are a type of SEP, 457 deferred comp plans, even 125 cafeteria plans. Those are generally excluded from your federal income tax in the year you defer them. That's a significant upfront tax benefit, right? It immediately reduces your taxable income right now. However, and this is a really vital nuance, these deferrals are still included in your wages for Social Security, Medicare, and FUTA taxes, the Federal Unemployment Tax Act. So while you get an income tax break now, you're still paying those payroll taxes on the deferred amount. This creates an immediate cash flow impact. Your current income tax bill is lower, sure, but your FICA and FUTA tax obligations, those remain.
Ah, okay. So it's not a complete tax vanishing act across the board that's subtle, but yeah, a critical detail for understanding your current tax burden. Now let's dive into maybe the most common individual retirement vehicles, IRAs. We're talking traditional versus Roth IRAs, often presented as this fundamental choice, right? The classic pay tax now or pay tax later dilemma. What's the core difference between these two? What should our listeners really understand about each one?
Yeah. At their core, traditional and Roth IRAs offer really distinct tax treatments. They're designed to align with different financial strategies, different outlooks. With a traditional IRA, the general idea is that your contributions may be tax deductible right now in the present. That leads to immediate tax savings. Your money then grows tax deferred. That means you don't pay tax on the earnings until you actually withdraw them in retirement. It's like pushing your tax bill down the road. The Roth IRA kind of flips this script. You contribute with after-tax dollars today, so there's no immediate deduction. But the really powerful advantage is that your qualified distributions in retirement, they're completely tax-free. So it's about paying your taxes up front for that promise of tax-free growth, and importantly, tax-free withdrawals later on.
Okay, let's focus on the traditional IRA first then. What are its key features? And maybe more importantly, how do we figure out if our contributions are actually deductible? Because that's where the current tax savings piece comes in. And like you said, it's not always straightforward.
You're absolutely right. It is a common point of confusion. For a traditional IRA, there's a nice change recently. No age limit for opening or contributing after 2019. That's helpful. Your contributions must be in money, say cash, check, money order. You can't contribute, say, property. Now, deductibility. That's the nuanced part. It primarily depends on your modified adjusted gross income, or AGI, and crucially, whether you or your spouse are covered by a retirement plan at work. For example, if you are covered by a workplace plan, or your spouse is, there are income phase-out ranges. These determine how much, if any, of your traditional IRA contribution you can actually deduct. These income numbers change pretty much every year, so it's always best to check the latest IRS guidelines. But the principle is the same. Higher income earners might see their deduction reduced or even eliminated entirely.
Right. And I remember hearing something about a specific spousal loophole here. Is that right? Like, what if one spouse is covered by a plan at work but the other isn't? Does that change the AGI limits for deductibility for the spouse who isn't covered?
Yes, exactly. That's a very important detail for couples, a potential planning opportunity. If you're married and your spouse is covered by a retirement plan at work, but you are not, and you either live with them or file a joint tax return, then your deduction phases out at a much, much higher modified AGI level. This can provide a really significant opportunity for tax savings that might not otherwise be available if both spouses were covered by workplace plans. It just underscores why every family situation really needs to be looked at individually.
Okay, so for high-income earners, that deduction might just not be available at all, which, yeah, could make other planning strategies seem more appealing. This really drives home the importance of a personalized decision-making process.
Definitely. And what about the actual contribution limits for IRAs? And what happens if you accidentally put in too much? Right. The individual contribution limits for both traditional and Roth IRAs are set by the IRS. They also adjust periodically, usually for inflation. These limits are separate from and generally much lower than the elective deferral limits for employer plans like 401k. If you contribute more than the allowed amount to your IRA in a given year, well, you're looking at a 6% excise tax penalty. And that's on those excess contributions for each year they remain in the account. The good news, though, is you can often correct these mistakes. You can typically apply the excess amount to a later year's contribution as long as that later year's contribution is below the maximum allowed for that year. So it's not like an irreversible disaster, but it definitely incurs a penalty if you don't address it promptly.
Okay, 6% penalty, good to avoid. Now, let's flip the coin to the Roth IRA. This is the one that promises that tax-free growth, those tax-free withdrawals later. What are its core features, and what exactly makes a distribution qualified and therefore completely tax-free? 'Cause that's the magic word, right? Qualified.
The Roth IRA is incredibly attractive. Yeah, precisely because of that tax-free potential down the road. Like the traditional IRA, no age limit for opening or contributing after 2019. The key feature, as you mentioned, is contributions are made with after-tax dollars. No upfront deduction. But the big draw, the headline, is that qualified distributions are completely tax-free, both contributions and earnings. Now, to be a qualified distribution, it has to meet two main requirements. First, it must be made after a 5-year period, and that clock starts ticking with the first tax year you contributed to any Roth IRA you have, not necessarily the specific Roth IRA you're withdrawing from. Second, the distribution has to meet at least one of these conditions. It's made on or after you reach age 59 and a half. It's made because you become disabled. It's made to a beneficiary or your estate after your death. Or it's used for a first home purchase, though there are specific rules and limits around that last one.
Okay, so that 5-year clock is super important for actually unlocking those tax-free benefits.
Got it. And what about contribution limits for Roth IRAs? Are they also subject to income limitations like the deductibility for traditional IRAs?
Yes, they are. Roth IRA contributions are also subject to modified AGI phase-outs. High-income earners may find their ability to contribute directly to a Roth IRA reduced or even eliminated entirely. And these income thresholds are typically different from the traditional IRA deductibility phase-outs, so you really have to check both if you're considering contributing. Oh, and a critical point to remember regarding Roth conversions.
Right, moving money from traditional to Roth.
Exactly. If you convert a traditional IRA to a Roth IRA, any conversion made after December 31st, 2017 cannot be recharacterized back to a traditional IRA. This is a huge change. It used to be you could undo a conversion if, say, the market tanked right after you converted. Not anymore. It's now a significant irreversible tax event. You pay the tax on the conversion, and that's that. It's a decision you need to make with very careful consideration. Wow, that's a huge takeaway. No takebacks on Roth conversions post-2017. That's permanent. So if we connect this back to the bigger picture that pay tax now or later decision, it really boils down to anticipating your future tax rates, doesn't it? Like, if you expect to be in a higher tax bracket in retirement than you are now, a Roth IRA could be golden.
Precisely. It's fundamentally a bet on your future tax bracket, or maybe just a desire for tax diversification in retirement. If you foresee your income, and therefore your tax bracket, being significantly higher when you retire, maybe you'll have fewer deductions or just higher aggregate income from various sources, then paying the tax now at your current, potentially lower rate is a really powerful strategy. You effectively lock in today's tax rates on that money, and that provides completely tax-free income when you might need it most, assuming, of course, you meet those qualified distribution rules we talked about. It's a strategic choice, and it can pay off handsomely over decades.
Okay, that gives us a really good handle on individual IRAs. Now let's pivot to employer-sponsored plans, because for small business owners, this can be a whole toolkit of different options. SEP, Simple, and 401k. Let's start with the Simplified Employee Pension, or SEP IRA. Who is this typically designed for?
The SEP IRA is generally an excellent option for sole proprietors, partnerships, and other small businesses. It's known for its relative simplicity. The mechanism is pretty straightforward. The employer makes contributions directly to an IRA set up for each eligible employee, including the owner themselves. The contributions the employer makes for their common law employees are deductible for the employer. So a sole proprietor would deduct them on their Schedule C, a partnership on Form 1065, and so on. It's a relatively simple way to set up a retirement plan without the sometimes significant administrative complexity that can come with a full-fledged 401k.
Okay, simple sounds good. And what about the contribution limits for a SEP IRA? Are they generous, like compared to a 401k or more like a traditional IRA?
Well, what's compelling about SEP IRAs is just how generous the limits can be, especially compared to individual IRAs. For a given year, the contributions an employer makes for an employee cannot exceed the lesser of two amounts: a specific percentage of the employee's compensation, like 25%, or a maximum dollar amount. And that dollar amount changes annually. For example, it was a hefty $69,000 for 2024, going up to $70,000 for 2025. There's also an annual compensation limit that gets factored in, capping how much salary can be considered. Now, for self-employed individuals figuring out their own maximum deductible contribution, there are special rules. It requires a specific calculation, often using an IRS worksheet, to adjust for the deduction for self-employment tax. But the bottom line is SEP IRAs can allow for very substantial contributions, making them really attractive for profitable small businesses or self-employed individuals.
Wow, yeah, $69,000 or $70,000 is a lot more than the IRA limits. But there's that specific calculation for the self-employed. Okay. And how are these deferrals taxed, particularly for something like a SARSEP? That's a specific type of SEPDEB, right? And are there any potential pitfalls with SEP?
Right. SARSEPs, Salary Reduction Simplified Employee Pension Plans, are a bit older and can't generally be established anymore, but some still exist. For those traditional SARSEP elective deferrals, they are generally excluded from an employee's wages subject to federal income tax in the year of deferral. But like other deferrals we discussed, they are included in wages for Social Security, Medicare, and FUTA taxes. If there's a Roth component to a SARSEP, those elective deferrals are immediately subject to all federal taxes in the year of deferral.
Yeah.
As for pitfalls, if highly compensated employees make excess contributions that go beyond permitted amounts, maybe due to non-discrimination rules, the employer has to correct this. If not, there can be penalties, including a 10% tax on that excess amount if it's not addressed properly and timely.
Okay, clear incentive for compliance there. Got it. Now, what about the simple IRA? As the name suggests, is it truly simpler than a SEP or a 401k?
The simple IRA often lives up to its name in certain respects. It offers a streamlined option, typically for small employers, think 100 or fewer employees who don't currently have another qualified retirement plan. It generally involves two types of contributions: salary reduction contributions from the employees, their elective deferrals, and employer contributions. The employer contributions can be either a required matching contribution, up to 3% of compensation, or a non-elective contribution of 2% of compensation for each eligible employee. Employer contributions are deductible for the business in the tax year, and there's that same helpful rule. They can be made right up until the due date of the business's tax return for that year, including extensions. Like regular IRAs, a simple IRA can have traditional or Roth variations, but their specific rules are distinct from regular traditional or Roth IRAs. So it's generally simpler to administer than a 401k, making it a good stepping stone for very small businesses. The trade-off is usually lower contribution limits compared to SFPs or 401ks.
Lower limits, but maybe easier administration. Makes sense. And finally, the 401k plan, often seen as the gold standard for many employers. What are its defining features and contribution limits? And what's this safe harbor 401k thing?
The 401k offers really significant flexibility for both employees and employers. The elective deferral limits, which we mentioned adjust annually, apply directly here. For 2024, that was $23,000, plus an additional $7,500 catch-up contribution for those age 50 or over. These limits apply for 2025 as well, with the base limit increasing slightly to $23,500. Now, for employers, a safe harbor 401k plan is particularly appealing. It's a huge deal, actually. If an employer meets specific requirements, usually by making certain mandatory matching contributions or non-elective contributions to all eligible employees, their plan is automatically exempt from these complex annual non-discrimination tests. These tests, often called the ADP and ACP tests, are designed to ensure that the plan doesn't unfairly benefit highly compensated employees compared to non-highly compensated employees. They can be a real headache to administer and pass. So by meeting the safe harbor rules, a business significantly simplifies its compliance burden. It makes offering a robust retirement plan much easier and more predictable.
Avoiding those complex tests, that sounds like a huge benefit for the plan administrators, yeah. Less hassle, more certainty. And within 401ks, we also have these designated Roth accounts. How do those differ from the Roth IRAs we talked about earlier? They sound similar.
That's a really important distinction to make because, they sound similar, but operate within different frameworks. Designated Roth accounts are separate accounts within an employer's plan, like a 401k or a 403b or a governmental 457b plan. They accept what are called Roth contributions. These are elective deferrals that, just like Roth IRA contributions, are included in your income in the year they're made, so after tax. However, the powerful benefit is the same as a Roth IRA. Qualified distributions from these designated Roth accounts are completely tax-free later on, both their contributions and all the earnings. The key difference is they exist as part of a workplace plan, not as individual accounts you open on your own. And critically, contributions to a Roth IRA and contributions to a designated Roth account within your employer's 401k are separate. They're subject to their own respective limits. Contributing to one doesn't affect your eligibility or limit for the other. So you could potentially max out contributions to both if you qualify, and your plan offers the Roth 401k option. That's a way to significantly increase your tax-free retirement savings potential.
Wow. Okay. So you could max out a Roth IRA and a Roth 401k contribution if you're eligible. That's a powerful combination for maximizing tax-free growth. So in essence, 401ks, especially those safe harbor versions, really provide that significant flexibility and those high contribution limits that are attractive to both employees and employers. Seems like a win-win if set up right. Now that we've covered the different types of plans, let's talk about the general rules that apply to these qualified retirement plans, especially how you move your money around rollovers and when you can take it out without getting hit with penalties. First, what exactly makes a plan qualified, and how are contributions generally handled?
Right. A qualified plan is a broad term in the IRS world, but fundamentally it means the plan must be established in writing and then communicated to all the eligible employees. It could be an IRS pre-approved plan document, often provided by a financial institution or benefits provider, or it could be an individually designed plan, usually for larger companies. The plan document explicitly states all the rules, eligibility, contributions, vesting, distributions to ensure fairness and adherence to tax laws. It's the rule book. Contributions are generally made by the employer, but many plans, like 401ks, allow employee contributions too. And a helpful detail we touched on earlier is that deadline flexibility for making deductible employer contributions. You can often contribute for a tax year right up to the due date of your business tax return for that year, including any extensions. Gives businesses some breathing room for cash flow planning.
That extended deadline is definitely a plus for year-end planning for businesses. Okay. Let's talk about rollovers, moving your money from one retirement account to another without hopefully incurring taxes. What qualifies as an eligible rollover distribution, and what are the key pitfalls to avoid, like that withholding thing?
Right. An eligible rollover distribution is basically any distribution of all or part of an employee's balance from a quantified retirement plan, except for certain specific types of payments. It does not include required minimum distributions, RMDs, those mandatory withdrawals you have to take later in life. It also doesn't include hardship distributions or certain long-term periodic payments, or loans treated as distributions. Now, a critical point for listeners. The 20% mandatory withholding rule. If an eligible rollover distribution is reasonably expected to total $200 or more over the year, and is paid directly to you, not to another plan, the payer must withhold 20% of the taxable portion for federal income tax. This is a big deal because that 20% is sent to the IRS. If you then want to roll over the full amount, you have to come up with that 20% out of your own pocket to add to the 80% you received. If you only roll over the 80%, the 20% withheld is treated as a taxable distribution, potentially subject to penalties.
Oh, yeah. So, direct rollover is the key phrase then. To avoid that immediate 20% withholding and the potential tax headache, how does that work? And what if you do get the check and miss the typical 60-day deadline for rolling it over yourself?
The direct rollover is absolutely the preferred method, yes. Instead of having the check made out to you, you instruct the distributing plan to transfer the funds directly to the trustee of the receiving plan, or IRA. This entirely bypasses that 20% mandatory withholding. The money never touches your hands, so there's nothing to withhold from. Now, if you do receive the distribution directly, you generally have 60 days from the day you receive it to complete the rollover into another eligible plan or IRA. What if you miss that 60-day deadline? Well, there's actually some welcome flexibility now, particularly under IRS Revenue Procedure 2020-46. It allows for self-certification if you miss the 60-day deadline, due to one of several specific reasons, things like an error by the financial institution, misplacing the check and it wasn't cashed, severe damage to your home, a family death or illness, postal errors. This provides a valuable relief valve for genuine mistakes or unexpected circumstances, rather than having the whole amount become taxable.
That self-certification is a really welcome safety net for those life happens moments. Good to know. Now, a really, really important distinction, especially for beneficiaries. How do spousal inherited IRAs differ from non-spousal inherited IRAs? This seems like a point of significant difference with major tax implications down the line.
This is absolutely critical, yes. It can have vast implications for how inherited wealth is taxed and managed. A surviving spouse has significant flexibility. They can generally choose to roll over a deceased spouse's IRA into their own IRA. This allows them to treat the IRA essentially as their own, meaning they can make contributions, if eligible, and importantly, base the required minimum distributions, or RMDs, on their own age, potentially deferring distributions for much longer and continuing that tax-advantaged growth. However, if you inherit a traditional IRA from anyone other than your deceased spouse, say, a parent, sibling, friend, the rules are much stricter. You cannot treat that inherited IRA as your own. You can't make contributions to it. You cannot roll amounts into it from other accounts, nor can you roll amounts out of it into your own IRA. You can usually do a direct trustee-to-trustee transfer, but it must be to another inherited IRA set up specifically in the deceased's name for your benefit as the beneficiary. And importantly, non-spousal beneficiaries are often subject to rules requiring them to distribute the entire account balance within 10 years of the original owner's death, greatly limiting the flexibility and long-term deferral potential compared to what a spouse can do.
Wow, okay, that's a crucial difference. Spousal inheritance offers way more flexibility than non-spousal. That can literally save or cost a lot in taxes over time. Huge distinction. What about automatic rollovers? And how do rollovers work for Roth accounts specifically? Want to make sure that Roth money stays Roth, right?
Yeah, good points. For qualified plans, like 401k, if you leave your job and have a vested balance over $1,000, but generally not more than $7,000, that limit can change. The plan might be required to automatically roll over your money into an IRA set up for you if you don't provide other instructions. This is designed to preserve retirement savings, keeping the money in a tax-advantaged account instead of just being cashed out. As for Roth accounts, this is key. Distributions from a designated Roth account, like a Roth 401k, can be rolled over to another designated Roth account in another plan. But to preserve the tax-free status completely, this must be a direct trustee-to-trustee rollover. Alternatively, you can roll over funds from a designated Roth account to a Roth IRA. This can be done either directly or via the 60-day rollover method, though direct is still generally safer to avoid withholding issues if any pre-tax money is involved. The absolute key is maintaining that Roth after-tax status throughout the rollover process to ensure that future qualified distributions remain completely tax-free. You don't want to accidentally mix it with pre-tax money in a way that complicates things.
Got it. Keep Roth money with Roth money, preferably through direct transfers. Okay, let's talk about the flip side of distributions, the additional taxes and penalties you absolutely want to avoid. What's the required beginning date, or RBD, for distributions, and what's that standard penalty for taking money out too early?
Right. The required beginning date, or RBD, is the deadline by which you generally must start taking money out of your traditional retirement accounts. For most individuals, this is April 1st of the year after the year you reach age 73. Note, this age has changed over recent years, so always good to confirm the current age. If you're still working past age 73 for the company sponsoring the plan, you might be able to delay RMDs from that specific plan until you actually retire, but not from your IRAs. Failing to take these required minimum distributions, or RMDs, on time, that can result in a hefty penalty. Currently, it could be 25% of the amount you were supposed to withdraw but didn't, potentially reduced to 10% if corrected timely. As for taking money out too early, if you take a distribution from most retirement plans before you reach age 59 and a half, the standard penalty is a 10% additional tax on the taxable portion of that distribution. This is on top of the regular income tax you'd owe. It's specifically designed to discourage people from tapping into their retirement funds prematurely.
Ouch. Yeah, 10% plus regular income tax can really sting. But thankfully, there are some very practical exceptions to that 10% penalty that our listeners should definitely be aware of. What are some of those key exceptions? Maybe the most common ones people might encounter.
Yes, absolutely. There are indeed several important exceptions to that 10% early withdrawal tax that can provide crucial flexibility in specific, often necessary circumstances. For example, distributions used for qualified higher education expenses are generally exempt. This can cover tuition, fees, books, supplies, and required equipment for you, your spouse, your kids, or even grandkids at an eligible school. And if the student is enrolled at least half-time, it can sometimes cover room and board too. Another very common one is for first-time homebuyer distributions. You can generally take up to $10,000 lifetime from an IRA penalty-free to help buy, build, or rebuild the first home for yourself or certain family members. There are specific rules, like the funds usually have to be used within 120 days. Other key exceptions include distributions made due to total and permanent disability, distributions to pay for unreimbursed medical expenses that exceed 7.5% of your adjusted gross income, distributions made after the account owner's death, and even distributions taken as part of substantially equal periodic payments. And there are newer exceptions too, like for qualified birth or adoption expenses up to $5,000, and even certain distributions for victims of domestic abuse. The IRS lists all these out, but the key takeaway is that 10% penalty isn't absolute. Exceptions exist for significant, often unavoidable life events.
Those exceptions are incredibly valuable, yeah. Covers a lot of major life moments where you might really need access to funds. Now let's touch on something that sounds pretty serious. Prohibited transactions. What are they exactly, and what are the consequences? Sounds like something you definitely want to avoid.
They are very serious, yes. And definitely something to avoid. Prohibited transactions are essentially specific types of improper dealings between your retirement plan, like an IRA or a qualified plan, and a disqualified person. A disqualified person can include yourself, the account owner or plan participant, certain family members, your employer, if it's an employer plan, or businesses you control. Examples: if you as an individual borrow money from your SEP or simple IRA, that's prohibited. Using your IRA assets as collateral for a personal loan, also prohibited. Selling property to your IRA or buying property from it personally, generally prohibited. The consequences are severe. If you or a beneficiary engage in a prohibited transaction with your IRA, for instance, that account stops being treated as an IRA as of the first day of the tax year the transaction occurred. All of its assets are then treated as distributed to you at their fair market value on that first day. This can trigger a large taxable gain, plus you might owe that 10% early withdrawal penalty if you're under 59 and a half. For qualified plans and other disqualified persons engaging in prohibited transactions, there are excise taxes, initially 15% of the amount involved, potentially escalating to 100% if the transaction isn't corrected promptly. Correction generally means undoing the transaction to the extent possible, putting the plan back in the financial position it would have been in had the prohibited transaction never occurred.
Ouch. Losing IRA status or facing huge excise taxes? Yeah, sounds like a rapid way to erode your retirement savings. Definitely want to steer clear of those. How do you actually report these additional taxes or penalties like the early withdrawal tax or the RMD penalty to the IRS? Is there a specific form?
Generally, yes. You must use IRS Form 5329, which is titled Additional Taxes on Qualified Plans, including IRAs, and other tax-favored accounts. This form is used to calculate and report the taxes on things like excess contributions to IRAs or other accounts, early distributions, that 10% penalty, and failures to take required minimum distributions. If you have to file a regular individual income tax return, Form 2040, you complete Form 5329 and attach it. The total additional taxes calculated on Form 5329 are then carried over and entered on Schedule 2 of your Form 1040. If you don't have to file a regular Form 1040 return, but you still owe one of these additional taxes, maybe you only had an RMD failure, you would just file Form 5329 by itself with the IRS by the due date. Understanding this form is basically how you communicate these specific situations to the IRS and ensure you're accurately reporting and paying any additional taxes due.
Okay, Form 5329. Good to know. So we've walked through the different types of retirement plans, the rollovers, the distributions, the penalties, all the sort of mechanics and tax implications. Now let's try to bring it all together into more of a decision-making framework. For our listener, how can they conceptually approach the advantages and disadvantages? Thinking about traditional versus Roth and maybe employer-sponsored versus individual plans, how do you weigh those?
Yeah, that's the core question, isn't it? It's really helpful, I think, to use that analogy you mentioned earlier, like choosing a greenhouse for your financial garden. Each type of retirement account offers a different climate for your contributions, your seeds, and how your investments, your plants, grow over time, tax-wise. For traditional accounts, whether that's a traditional IRA, a SEP IRA, or a traditional 401k, the big pro, the main advantage, is that potential for an immediate tax deduction, assuming you're eligible based on income and workplace plan coverage. This means your contributions can reduce your taxable income right now in the present year. That offers an immediate cash flow benefit. Plus, your investments inside the account grow tax deferred. You don't pay tax on the earnings year after year, only when you withdraw them in retirement. The cons, however, the downsides. Withdrawals in retirement are taxed as ordinary income, and you'll eventually face those required minimum distributions, RMDs, which currently start at age 73, forcing you to take money out whether you need it or not.
Okay, so traditional. Tax break now, pay taxes later, force withdrawals later. Got it.
And what are the Roth options in that greenhouse analogy? What climate do they offer for your financial garden?
Right. For the Roth options, the Roth IRA, or maybe a designated Roth account within a 401k, the climate is quite different, and it offers some really compelling advantages, especially long term. The pros are immense, really. Your contributions are made with after-tax money, so yeah, no immediate deduction. But then you enjoy completely tax-free growth, and most importantly, tax-free qualified withdrawals in retirement. That includes both your original contributions and all the accumulated earnings. Plus, for the original Roth IRA owner, there are no RMDs during their lifetime. This offers incredible flexibility in managing retirement income and for estate planning. This makes Roth options potentially excellent if you anticipate being in a higher tax bracket during retirement than you are today. The primary cons, well, that immediate lack of a tax deduction, and the fact that direct contributions to a Roth IRA are subject to those income limits we discussed. Yeah, that tax-free qualified withdrawal, that really is the golden fruit you're hoping for in retirement, isn't it? Especially if taxes might be higher then. And how do employer-sponsored plans like 401ks or SAPs compare overall to individual IRAs in this decision framework?
That's where scale and sometimes employer generosity come into play. Employer plans 401k, SAP, Simples, generally allow significantly higher annual contributions than individual traditional or Roth IRAs. We mentioned the SEP limits potentially reaching $69,000 or $70,000. Compare that to the IRA limits, which were $7,000 for 2024 for those under 50, plus a $1,000 catch-up if 50 or over. It's a massive difference in potential savings capacity. Employer plans also frequently include employer contributions, matching funds, or profit sharing. That's essentially free money for the employee, a direct boost to your savings. They also often simplify the setup and administration for the employee. Individual IRAs, on the other hand, offer great flexibility, especially if employer plans aren't available to you, or if the employer plan has limited investment options or high fees, or if you just want more direct control over your investment choices. For the self-employed, specifically, SEPs and Simples can be superb options. They strike a balance between potentially high contribution limits, especially SEPs, and somewhat simplified administration compared to setting up and running a full 401k, or, say, a defined benefit plan.
So the best choice, or combination of choices, really depends on your specific situation. Your income, your employment status, your access to workplace plans, your savings goals, and crucially, that forecast of your future tax situation. Will future tax rates be higher or lower for you? That's often the core strategic question when deciding between traditional and Roth.
Decoding investment income and taxation. Beyond the basics.
All right, I feel like we've got a really solid handle on the retirement plan landscape now. That framework is super helpful. Let's shift our focus now to the investment income itself. Because like we said, it's not just about how much your investments grow on paper, but how that growth is actually taxed that truly impacts your net return, what you actually get to keep and use. We're going to break down the three main pillars of investment income: interest, dividends, and capital gains. Let's start with interest income. It seems straightforward, but you mentioned earlier there are some critical tax nuances, aren't there?
You're absolutely right, yeah. While interest income might seem like the simplest form, its tax treatment can vary considerably based on where it comes from. Generally, interest you receive from sources like corporate bonds, certificates of deposit, CDs from banks, or even interest paid on notes between individuals. That's typically fully taxable at the federal level. And usually it's taxed at your ordinary income tax rates, the same rates as your salary. But the source of that interest can significantly change its tax profile.
Like U.S. Treasury obligations, for instance. You mentioned there's a specific tax advantage there. Can you remind us what that is?
Indeed, yeah, this is a key advantage, especially valuable for people living in high-tax states. Interest you receive from U.S. Treasury bills, notes, and bonds is taxable at the federal level, yes, but it is explicitly exempt from state and local income taxes. This can result in really meaningful savings on your overall tax bill, particularly if your state or city has a high income tax rate. It makes treasuries relatively more attractive on an after-tax basis compared to, say, a corporate bond with the same yield.
Okay, state and local tax exemption for treasuries. Good to remember. Now, where it gets maybe a little more complex is with things called original issue discount, or OID, and also market discount bonds. What are those, and how are they taxed? This sounds a bit more in the weeds.
It is a bit more complex, yeah. OID, original issue discount, is essentially a form of imputed interest. It applies to certain debt instruments, like zero-coupon bonds or other bonds that are issued at a price below their face value, par value. The key takeaway here is that this discount, the difference between the issue price and the face value, is generally taxable annually as interest income over the life of the bond, even if you don't receive any actual cash interest payments until the bond matures. You'll typically receive a Form 1099 OID from the issuer reporting the amount of OID you need to include in your income each year. This is often called phantom income because you owe tax on income you haven't received in cash yet. Market discount bonds are a bit different. This happens when you buy a bond in the secondary market for a price below its stated redemption price, usually face value. This discount arises due to market factors like rising interest rates after the bond was issued. If you buy a bond with market discount and you don't elect to include that discount in your income currently as it accrues, then when you later sell or dispose of the bond, or if you receive partial principal payments, any gain you realize will be treated as ordinary interest income up to the amount of the market discount that has accrued while you held the bond. The critical insight with both OID and market discount bonds is that potential for owing tax before you actually receive the cash. This means they require careful cash flow planning, or perhaps are often best held within tax-advantaged accounts where the phantom income isn't currently taxed, or maybe are just better suited for more sophisticated investors who understand these implications.
Okay, phantom income owing tax before you get the cash, that's definitely a crucial consideration, especially for OID. And then there are the truly tax-exempt sources, like municipal bonds. But even those, you hinted, have a potential catch sometimes. With the AMT,
Precisely. Interest from bonds issued by state and local governments, municipal bonds, or munis, is generally tax exempt at the federal level. This is a huge draw for many investors, particularly those in higher federal tax brackets, as it can provide income completely free of federal income tax. However, there's a crucial caveat you mentioned, the alternative minimum tax, or AMT. If the municipal bonds are classified as private activity bonds, meaning they primarily benefit a private entity rather than the general public, the interest earned on them, while still exempt from regular federal income tax, can be considered a tax preference item.
Yep.
And tax preference items get added back into your income when calculating the AMT. The AMT is that separate parallel tax system designed to ensure higher income individuals pay at least a minimum level of tax, regardless of certain deductions and exemptions used in the regular tax system. So, while most muni interest is federally tax-free, it's vital to check if the specific bonds you hold are private activity bonds, especially if you might be subject to the AMT. It could negate some of the intended tax benefit. Oh, and a quick clarification we should make, money market funds. While they feel like savings accounts, they generally pay dividends, not interest, and are treated as dividend income for tax purposes, even if they invest primarily in short-term debt.
okay, so munis usually federally tax-free, but watch out for private activity bonds and the AMT. Got it. And money market funds pay dividends. Let's move from interest to dividends then. This is another area where the tax treatment isn't always the same. Depends on whether they're ordinary dividends or qualified dividends. What's the distinction, and why does it matter so much for your bottom line?
The distinction between ordinary and qualified dividends can dramatically, really dramatically impact your net return after taxes. Ordinary dividends are just what they sound like. They're taxed at your regular, ordinary income tax rates, same as your salary, same as taxable interest income. For top earners, this can mean federal rates approaching 40%, but then you have qualified dividends. These are the real gems from a tax perspective. If the dividends meet certain specific conditions, they are taxed at the much lower long-term capital gains rates. This is a huge potential benefit, as those long-term capital gains rates are significantly less than ordinary income rates, typically 0%, 15%, or 20% at the federal level, depending on your overall taxable income. That's a massive difference compared to ordinary rates.
Okay, qualified dividends get the lower capital gains rates. Huge difference. What are those conditions? Like, what makes a dividend qualified? What kind of companies pay them?
Right, there are a few key requirements. First, the dividend must be paid by a U.S. corporation or a qualified foreign corporation. Second, the dividends must be actual dividends, not something else labeled as a dividend, like capital gain distributions from mutual funds or payments in lieu of dividends. And third, you must meet a holding period requirement. Generally, you have to have held the underlying stock for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date. For preferred stock, the holding period is usually longer, more than 90 days during a 181-day period. This holding period rule prevents people from just buying a stock right before the dividend, getting the qualified rate, and selling right after.
Okay, source matters, U.S. or qualified foreign, and holding period matters, more than 60 days usually. What generally qualifies a foreign corporation for those lower rates? And are there any types of entities that typically don't pay qualified dividends, even if they pay distributions?
Good question. For a foreign corporation's dividends to be potentially qualified, either its stock must be readily tradable on an established securities market in the United States, like the NYSE or NASDAQ, or the corporation must be incorporated in a U.S. possession, or it must be eligible for the benefits of a comprehensive income tax treaty with the U.S. that includes an information exchange program. What's important to note is which entities typically do not pay qualified dividends. This commonly includes distributions from real estate investment trusts, REITs, and regulated investment companies like most mutual funds and ETFs. While these entities pass through income, those distributions are often classified as ordinary dividends or capital gain distributions, not qualified dividends. Also, dividends received from certain entities like credit unions or dividends paid on employee stock options usually don't qualify. And dividends from passive foreign investment companies, PFICs, are specifically excluded. So while dividends are generally seen as investment income, the type of dividend and its source can drastically change your take-home amount after taxes are factored in. You really need to look at the details on your Form 1099 DIV.
Right, got to check that 1099 DIV carefully. That distinction between ordinary and qualified truly impacts your net return, really underscoring that net of tax impact measure of success we keep talking about.
Okay, now on to the third pillar, capital gains and losses. This is the classic buy low, sell high story, or sometimes, unfortunately, buy high, sell low. How are these treated from a tax perspective, and what exactly counts as investment property here, especially with newer assets?
Right. Investment property, or capital assets, as the tax code often calls them, includes a wide range of things you hold for investment. Think stocks, bonds, mutual funds, treasury bills, and notes. Importantly, and this is crucial in today's world, for federal income tax purposes, digital assets like cryptocurrencies, Bitcoin, Ethereum, etc., and non-fungible tokens, or NFTs, are treated as property. This means the general property transaction rules apply to them. When you sell, exchange, or otherwise dispose of a digital asset, you'll typically have a capital gain or loss, just like with stocks or bonds. Now, the most fundamental distinction for capital gains and losses, the one that has the biggest tax impact, is whether they are short-term or long-term. It all comes down to holding period.
Okay, holding period again. What's the difference between short-term and long-term here? And why is that distinction so absolutely crucial for your overall tax bill?
It's absolutely fundamental, yeah. Short-term capital gains or losses apply to assets you held for 1 year or less, so 365 days or fewer. Any net short-term capital gains are taxed at your ordinary income tax rates, just like your salary, just like ordinary dividends, just like taxable interest. So if you're in a high-income bracket, your short-term gains could be taxed at those top marginal rates. Long-term capital gains or losses, on the other hand, apply to assets you held for more than 1 year, so 366 days or more. Net long-term capital gains are taxed at those much more favorable preferential long-term capital gains rates. As we mentioned with qualified dividends, these rates are typically 0%, 15%, or 20% at the federal level, depending on your overall taxable income level. For most people, that's significantly less than their ordinary income tax rate. This difference is why holding on to a winning investment for just one extra day to get past that 1 year mark can literally save you a substantial amount of money in taxes, especially on a large gain. The tax difference between short-term and long-term treatment can be massive.
Yeah, one day can make a huge difference. Holding for over a year is key for those lower rates.
Got it. And what about expenses related to selling investments, like broker's fees or commissions? Do those reduce your taxable income separately?
Brokers' fees, commissions, state and local transfer taxes, things like that, which you incur when you sell an investment, they are not deductible as separate itemized deductions. Instead, they are added to your cost basis when you buy, and they reduce your proceeds when you sell. So effectively, they reduce your capital gain or increase your capital loss. For example, if you sold stock for $10,000 and paid a $50 commission, your amount realized for calculating gain or loss would be $9,950. It directly impacts the calculation of your gain or loss on that specific transaction.
Okay, so they reduce your taxable profit directly, not a separate deduction. Makes sense. And how do capital losses work? Can they offset gains, and can you use them to reduce your regular income, like your salary? Capital losses are actually a valuable tool for tax planning, believe it or not. They can first be used to offset your capital gains. Short-term losses offset short-term gains first. Long-term losses offset long-term gains first. Then, any remaining losses can offset the other type of gain. If, after netting all your gains and losses, you still have a net capital loss for the year, you can use up to $3,000 of that net loss, $1,500 if married filing separately, to offset your ordinary income, things like wages, interest income, etc. Any capital loss that exceeds that $3,000 limit isn't lost forever, though. It can be carried over indefinitely to future tax years. In future years, it retains its character, short-term or long-term, and can be used to offset future capital gains, and again, up to $3,000 of ordinary income each year until it's fully used up. This provides a helpful way to get some tax benefit from investment losses, mitigating some of the financial sting.
Okay, losses offset gains, then up to 3Ks of ordinary income, and the rest carry forward. That's a helpful buffer. But there's a trap to watch out for called a wash sale. What is that exactly, and why does the IRS disallow the loss in that situation?
Yes, the washed sale rule. It's a tax rule specifically designed to prevent taxpayers from creating artificial losses solely for tax purposes while essentially maintaining their investment position. Here's how it works. If you sell stock or securities, including mutual funds or options, at a loss, and then you buy substantially identical stock or securities within 30 days before the sale date or within 30 days after the sale date, that loss you realized on the sale is disallowed for tax purposes in that year. This creates a 61-day window, 30 days before the sale day, 30 days after, around the sale date. If you repurchase within that window, no loss deduction on the sale. The rule applies whether you buy the replacement stock in a taxable account or even in some cases in an IRA or Roth IRA. It also applies if your spouse or a corporation you control buys the substantially identical security within that window. Why is it disallowed? Because you haven't truly changed your economic position. You sold the loser, claimed a tax loss, but immediately bought it back, or something very similar. The tax code says you can't have it both ways. The disallowed loss isn't completely lost, though. It's typically added to the cost basis of the new replacement stock you purchased. This means you'll have a lower capital gain or a larger capital loss when you eventually sell that replacement stock in the future, assuming you don't trigger another wash sale then.
Okay, so selling and rebuying, basically the same thing within about a month, means no loss deduction now, but it adjusts the basis for later. Good to know that 61-day window. What if the security becomes completely worthless? Like a company goes bankrupt, the stock is delisted and has no value. How is that treated for tax purposes?
Right, that unfortunately happens sometimes. If a security you own, like stock or a bond, becomes totally worthless during the tax year, it's treated for tax purposes as if it were sold or exchanged for $0 on the very last day of that tax year. This means you report it as a capital loss. Whether it's short-term or long-term depends on how long you held the security before that deemed sale date, the last day of the year it became worthless. You generally can't deduct it earlier, say, when the company files for bankruptcy. You have to wait until it's truly completely worthless, and then the loss is recognized as of year-end. You'd report this on Form 8 and 949, just like any other capital loss from a sale. You can't deduct it as an ordinary bad debt loss. It must be treated as a capital loss, subject to those capital loss limitations we discussed.
Okay, worthless security, capital loss recognized the last day of the year becomes worthless. Got it. Let's circle back quickly to digital assets, like crypto. Are there any specific rules for figuring out their cost basis or holding period, especially if they were gifted to you, not purchased?
Yes, there are some specific and sometimes tricky rules for gifted digital assets, similar to rules for gifted stock. When you receive digital assets as a gift and later sell them at a gain, your cost basis for calculating that gain is generally the same as the donor's basis that they paid for it, potentially increased by any gift tax the donor paid that was attributable to the appreciation in the asset's value. However, if you sell the gifted digital asset at a loss, your basis for calculating that loss is the lesser of either the donor's basis or the fair market value of the digital asset at the time you received the gift. This complex rule prevents people from gifting assets with built-in losses just to transfer the tax deduction. If the sale price falls between the donor's basis and the fair market value at the time of the gift, you recognize neither a gain nor a loss. Now, critical point here. If you lack documentation to substantiate the donor's basis, maybe they didn't keep good records or didn't tell you your basis for tax purposes is generally considered to be zero, that could result in a much larger taxable gain when you sell. As for the holding period for gifted assets, they typically tax on, meaning your holding period includes the time the digital asset was held by the donor if you use the donor's basis to determine your gain or loss. If you have to use the fair market value at the time of the gift to determine a loss, then your holding period begins the day after you receive the gift. So yeah, good record keeping, especially from the donor, is absolutely vital when dealing with gifted assets, digital or otherwise.
Wow. Yeah, different basis rules for gain versus loss on gifted assets, and the potential for zero basis if records are missing. Record keeping is definitely key there. Now, let's talk about a potentially powerful tax benefit, especially for entrepreneurs or investors in smaller grown companies. The Section 1202 exclusion for qualified small business stock, or QSBS. This sounds like it could be a significant advantage.
This is truly one of the most powerful tax benefits available for qualifying investments, yeah. Section 1202 allows you to generally exclude a significant percentage, sometimes even all, of your capital gain from the sale or trade of qualified small business stock, QSBS, if you've held that stock for more than 5 years. What makes it particularly compelling now is that for QSBS acquired after September 27, 2010, up to 100% of the gain can potentially be excluded from federal income tax, subject to certain overall limits per taxpayer per issuer. For stock acquired earlier, the exclusion percentage might be 50% or 75%. The portion of the eligible gain that isn't excluded is typically taxed as a 28% rate gain. What counts as QSBS? Generally, it has to be stock in a domestic C corporation acquired at its original issuance, not bought on the secondary market. The corporation must meet certain active business requirements, and its gross assets generally can't exceed $50 million at the time the stock was issued and immediately after. This exclusion can even apply to your share of gain from QSBS held by a pass-through entity like a partnership or an S corporation, provided you held your interest in the entity for the entire period the entity held the QSBS stock. It's a huge incentive designed to encourage long-term investment in small, growing U.S. businesses.
A potential 100% exclusion on capital gains from certain small business stock held over 5 years. That is remarkable. That's a game changer if you qualify. Are there other powerful tax incentives like that out there? You hear about qualified opportunity funds or QOFs sometimes. How do those work?
Yes, qualified opportunity funds are another substantial tax incentive program introduced more recently by the Tax Cuts and Jobs Act of 2017. They offer a couple of key benefits. First, if you have capital gains from selling any asset, stock, real estate, crypto, whatever, you can potentially defer paying tax on those gains if you reinvest the gain amount into a qualified opportunity fund within 180 days. The tax on the original gain is deferred until you sell your QOF investment or until December 31st, 2026, whichever comes first. Second, and perhaps even more compelling, is the potential for permanent exclusion of capital gains earned on the QOF investment itself. If you hold your investment in the QOF for at least 10 years, then any appreciation on that QOF investment could be entirely tax-free when you eventually sell it. Zero federal capital gains tax on the growth within the QOF held long term. QOFs are investment vehicles specifically set up to invest in designated low-income communities called opportunity zones. The program is designed to spur economic development and job creation in these distressed areas by providing these significant tax benefits to investors.
Okay, so QOFs offer gain deferral upfront and potential tax-free growth on the QOF investment itself if held 10 plus years. Another powerful tool aimed at specific types of investment. These are clearly powerful strategies for minimizing tax on certain investment gains. Let's shift now to some maybe even more specialized or complex situations in investment taxation. What about options, for example? Puts and calls, how are they generally taxed?
All right, options trading adds another layer. Generally speaking, the tax treatment of an option depends on whether you're the buyer, holder, or the seller, writer of the option, and what happens to it, whether it's exercised, expires worthless, or is sold before expiration. If you buy an option, a call or a put, and later sell, that option contract itself before it expires, your gain or loss is typically a capital gain or loss. Short-term or long-term depends on how long you held the option contract. If you buy an option and it expires worthless, you have a capital loss equal to the premium you paid for the option. Again, short-term or long-term depends on your holding period of the option. The loss is recognized on the expiration date. If you buy a call option and exercise it, buying the underlying stock, the premium you paid for the call is added to the cost basis of the stock you acquire. Your holding period for the stock begins the day after you exercise the call. If you buy a put option and exercise it, selling the underlying stock, the premium you paid for the put reduces the amount realized on the sale of the stock when calculating your gain or loss on the stock itself. Now, if you write sell an option. If you write a call or put and it expires worthless, the premium you received is treated as a short-term capital gain recognized in the year the option expires. If you write a call option and it's exercised, you have to sell the stock. The premium you received is added to the proceeds from the sale of the stock, increasing your gain or decreasing your loss on the stock. If you write a put option and it's exercised, you have to buy the stock. The premium you received reduces your cost basis in the stock you acquire. Your holding period for that stock begins when you buy it due to the exercise. So yeah, it's not just the underlying asset, but the specific action taken with the option contract itself that determines the tax treatment. It can get complicated quickly.
Wow, okay. Lots of different outcomes depending on whether you buy or write and whether it expires or gets exercised. Definitely need to track those carefully. You also mentioned some very specialized debt instruments earlier, remix and facets. Can you just briefly touch on why these are considered complex again and what that key tax implication is for people who might hold them?
Right. These are indeed quite specialized, usually found within complex structured finance deals. REMEX stands for Real Estate Mortgage Investment Conduit, and FACET was Financial Asset Securitization Investment Trust. Facets can no longer be created, but some might still exist. The regular interests in both REMEX and FACETs are generally treated as debt instruments for income tax purposes. The key tax implication, the really critical one for holders, is that they must use the accrual method of accounting to report the income from these interests. This means you generally have to include income in your taxable income as it accrues over time, even if you haven't yet received any corresponding cash payments. This is similar to the OID concept, but often applies more broadly to the income from these instruments. So again, you can have that phantom income situation owing tax on income that hasn't actually hit your bank account yet. This significant cash flow consideration makes these generally only suitable for very sophisticated investors or institutions that understand and can manage that timing difference.
Accrual accounting required, meaning potentially owing tax before getting cash. Yeah, it sounds like a significant cash flow consideration, definitely for sophisticated investors. Now, let's pivot to something really crucial for any investor to be aware of: abusive tax shelters. The IRS warns about these quite strongly. What are the red flags? What should our listeners watch out for to avoid getting caught up in something illegitimate?
This is a vital warning, yeah, because getting involved in an abusive tax shelter, even unintentionally, can lead to severe consequences: back taxes, interest, substantial penalties, maybe even criminal charges in egregious cases. The IRS defines these basically as marketing schemes that involve artificial transactions with little or no underlying economic reality, designed solely or primarily to generate tax benefits that aren't genuinely allowed by law. So, what are the red flags? Be wary of promotions that promise tax benefits that sound way too good to be true. Things like guarantees of huge deductions or credits with little or no risk. Look out for transactions that involve unnecessary steps or complexity, seemingly just to obscure the real nature of the deal. Inflated appraisals of assets used in the transaction are another common sign. Be suspicious of deals involving non-recourse loans where you're supposedly borrowing money but aren't personally liable to repay it if the investment fails, or financing terms that just don't seem commercially reasonable. Schemes that intentionally create mismatches between when income is reported and when deductions are claimed can be abusive. Or transactions that involve routing money through offshore accounts or tax havens for no clear business reason other than tax avoidance. A huge red flag is if the promoter pressures you to act quickly, discourages you from seeking independent advice, or requires you to sign confidentiality agreements about the secret tax strategy. Basically, if a deal focuses almost entirely on the tax benefits and seems to lack legitimate business purpose or economic substance, you should be extremely cautious. Ask yourself, would I do this deal if there were no tax benefits involved? If the answer is no, that's a warning sign.
Those are very clear warning signs. Too good to be true, unnecessary complexity, non-recourse loans, offshore stuff, high pressure. Definitely things to run away from. And what are the penalties for engaging in these, even if you didn't fully understand it was abusive? And are there specific disclosure requirements related to potentially problematic transactions?
The penalties can be really severe, unfortunately. Taxpayers who participate can be liable for all the back taxes owed, plus substantial interest charges. On top of that, there are often specific penalties related to tax shelters. For example, there's a penalty for substantial understatement of tax, which can be 20% of the understated amount, potentially increasing to 40% if the understatement is due to an undisclosed listed transaction or transaction lacking economic substance. Importantly, simply disclosing the tax shelter item on your tax return generally does not reduce the amount of this accuracy-related penalty if the transaction is ultimately deemed abusive. Yes, there are definitely disclosure requirements. The IRS requires taxpayers to disclose their participation in certain reportable transactions on Form 8886. These include listed transactions, which the IRS has specifically identified as tax avoidance schemes, confidential transactions, transactions with contractual protections, certain loss transactions, and transactions of interest. Material advisors who promote these transactions also have disclosure and list maintenance requirements. Failure to disclose properly can lead to significant additional penalties. The key takeaway here is due diligence is paramount. Get independent advice from a qualified tax professional who isn't involved in promoting the deal. And transparency with the IRS through proper disclosure is crucial if you do engage in a transaction that might be reportable. If something smells fishy, it probably is. Don't let the lure of tax savings blind you to the risks.
Absolutely. Due diligence, independent advice, transparency. Crucial for avoiding those pitfalls. Finally, in this section, let's briefly touch on some common limitations on investment-related deductions, things like investment interest expense, the at-risk rules, and passive activity loss limits. How do these impact what you can actually deduct against your investment income or other income?
Right. These are important limiting provisions in the tax code, generally designed to prevent taxpayers from using losses or expenses from certain types of investments to artificially offset other types of income, like wages or active business income. Let's start with investment interest expense. This is interest you pay on money you borrow specifically to buy property held for investment, like borrowing on margin to buy stocks. You can deduct this interest, but there's a big limitation. Your deduction is generally limited to your net investment income for the year. Net investment income includes things like taxable interest, ordinary dividends, annuities, royalties, and net short-term capital gains, plus any net long-term capital gains or qualified dividends you elect to treat as investment income, which means giving up the lower tax rates on them. Any investment interest expense you can't deduct because of this limit can generally be carried forward to future years. And critically, you cannot deduct interest you incur to purchase or carry investments that produce tax-exempt income, like municipal bonds. That interest is generally non-deductible.
Okay, investment interest deduction limited to net investment income. Got it. What about the at-risk rules?
The at-risk rules are another limitation, typically applying to losses from activities like holding real estate, with some exceptions, farming, oil and gas exploration, equipment leasing, and others. These rules limit the amount of loss you can deduct from such an activity to the amount you are considered at risk of actually losing in that activity. Generally, your amount at risk includes the cash you've contributed, the adjusted basis of property you contributed, and amounts you borrowed for the activity for which you are personally liable for repayment or for which you've pledged property, not used in the activity, as security. Importantly, amounts borrowed on a non-recourse basis where the lender can only look to the activity's assets for repayment, not your personal assets, generally do not increase your amount at risk. So, if your deductions exceed your at-risk amount, the excess loss is suspended and carried forward until you have sufficient at-risk basis in a future year.
Okay, loss deduction limited by what you personally stand to lose. Makes sense. And finally, the passive activity loss limits. This one comes up a lot, especially with rental properties.
Yes, the passive activity loss, PAL, rules are very significant. A passive activity is generally defined as any trade or business activity in which you do not materially participate, or any rental activity, even if you materially participate unless you qualify as a real estate professional. The basic rule is that losses from passive activities can only be used to offset income from other passive activities. You generally cannot use passive losses to offset your non-passive income, such as wages, salary, active business income, or portfolio income, interest, dividends, capital gains. Any passive losses you can't use because you don't have enough passive income are suspended and carried forward indefinitely. These suspended losses can then be used to offset passive income in future years, or they can generally be deducted in full when you dispose of your entire interest in that specific passive activity in a fully taxable transaction. There is a well-known exception for rental real estate activities. If you actively participate, a less stringent standard than material participation, and your modified adjusted gross income is below certain thresholds, phasing out between 100K and 150K generally, you may be able to deduct up to $25,000 of rental losses against your non-passive income each year. The core principle behind all these rules, investment interest limits, at-risk rules, PL rules, is really to ensure that tax deductions align with economic reality and prevent artificial losses from being used to shelter other unrelated income from tax.
That's a lot of important limiting rules to keep in mind, all designed, as you said, to make sure deductions reflect real economic substance.
Whew. Putting it all together. Strategic tax planning for your future.
Okay, we have taken a really comprehensive deep dive today. We've covered the nitty-gritty of retirement plans, traditional, Roth, SEP, simple 401ks, and we've dissected how different types of investment income interest, dividends, capital gains are taxed, along with all those rules and limitations. Now it's really time to bring it all together. How do all these moving pieces, choosing a retirement plan, understanding specific investment tax treatments, how do they actually interplay? How do they contribute to building, as you called it earlier, a robust financial ecosystem?
This is absolutely where the true power of understanding all this lies, I think. Because, as we've seen, choosing a retirement plan is never just a standalone decision about that one account. It profoundly impacts how the investments within that plan are going to be taxed or not taxed as they grow. And conversely, the types of investments you might favor could influence which type of account makes the most sense for you. It's genuinely about building this cohesive financial ecosystem where every component, your saving strategy, your investment choices, your withdrawal plans, is optimized for tax efficiency, working together towards your long-term goals. And that concept, we keep returning to the net of tax impact on your return on investment, your ROI, that becomes most starkly evident when you look at money growing inside these tax-advantaged retirement accounts compared to a regular taxable account.
Right. Can you maybe elaborate a bit more on that tax advantage growth within these accounts? How does it fundamentally change the long-term compounding of returns compared to just investing in, say, a regular brokerage account where you pay taxes along the way?
Yeah, let's connect this back to the bigger picture. Whether you're utilizing a traditional 401k or IRA with its tax-deferred growth, or a Roth IRA or Roth 401k with its potential for a completely tax-free growth, these vehicles fundamentally supercharge the long-term compounding of your returns. Think about it. In a taxable brokerage account, every year you might owe taxes on interest earned, on dividends received, qualified or ordinary, and whenever you sell an asset at a gain. Those taxes are a drag on your returns. They reduce the amount of money you have available to reinvest and continue growing. Inside a retirement account, those annual taxes are either delayed for potentially decades in a traditional account, allowing the full sum, including money that would have gone to taxes, to keep reinvesting and compounding, or those taxes are eliminated entirely on the back end in a Roth account for qualified distributions. This compounding effect, unhindered by that annual tax drag, is a massive, massive factor in long-term wealth accumulation. It means your ROI net of tax impact is dramatically higher inside these tax-advantaged structures over the long run, even if the underlying investments are identical.
The power of compounding without that tax drag makes a huge difference over time. And it's not just about the contributions in the growth phase, right? It's also about your withdrawal strategy in retirement that also significantly impacts your ultimate ROI net of tax impact.
Absolutely. It's the full life cycle. Understanding when and how you withdraw funds from your various accounts in retirement is absolutely key to preserving the gains you've made and avoiding unnecessary penalties or taxes. Knowing the required minimum distribution (RMD) rules for your traditional accounts helps you plan your income streams in retirement effectively, ensuring you take out enough to avoid penalties but maybe not more than you need, allowing the rest to continue growing tax-deferred for as long as possible. Being keenly aware of those various exceptions to the 10% early withdrawal penalty can provide crucial liquidity during unexpected life events without taking that extra tax hit. And executing rollovers correctly, especially using direct trustee-to-trustee transfers, is vital to avoid immediate tax withholding and ensure your funds seamlessly continue their tax-advantaged journey. It's all about having a cohesive strategy that considers the tax implications throughout your financial life cycle, from the first dollar you contribute right through to the last dollar you distribute.
It really is like that greenhouse analogy we used. Your retirement plan isn't just a passive container for your money. It's a carefully chosen environment for your investments to grow. Some parts of that greenhouse let you plant those tax-deductible seeds, but you know you'll be harvesting taxable fruits later. Other parts require you to plant after-tax seeds, but they promise completely tax-free fruits down the road. And the best choice of greenhouse, or maybe combination of greenhouses, fundamentally depends on your current financial climate, your income, your tax rate now, and what you anticipate for your retirement harvest, especially your expected tax rate then. So thinking beyond just those headline growth returns we see advertised, how does understanding this tax factor actually help you calculate your true ROI in practice? How does it change the comparison between different investment options?
That's a great question because, yeah, a seemingly high-performing investment might actually be significantly less attractive once you factor in the tax bite. For instance, consider an investment strategy that generates a lot of short-term capital gains, or maybe interest income tax at ordinary rates. If you're in a high income tax bracket, that 10% gross return might quickly become, say, a 6% or 7% net return after federal and maybe state taxes. Now, compare that to an investment that generates the same 10% gross return, but primarily through qualified dividends or long-term capital gains. For the same investor, that might translate to an 8% or 8.5% net return because those income types are taxed at lower preferential rates. Or, even better, if that 10% return happens inside a Roth IRA and is eventually withdrawn tax-free as a qualified distribution, the net return is 10%. So the statutory tax rates applied to different types of income, ordinary income rates versus long-term capital gains rates versus tax-free treatment, make a huge difference in what you actually keep. Calculating ROI net of tax is crucial for making valid comparisons.
That makes perfect sense. The tax rate applied to the gain, or income, makes all the difference in what hits your pocket. And for our self-employed listeners, is there a particular advantage we should re-emphasize in how their retirement contributions impact their true ROI?
Yes, absolutely. For the self-employed, there's often that powerful dual tax saving we touched on earlier, which directly impacts their effective ROI on contributions. When a self-employed individual makes contributions to plans like SEPs or traditional solo 401ks for themselves, those contributions generally reduce their adjusted gross income, lowering their income tax bill. That's benefit number one. But those contributions also typically reduce their net earnings from self-employment, which is the base figure used to calculate their self-employment taxes. That's the Social Security and Medicare taxes for the self-employed. That's benefit number two. So a dollar contributed to a retirement plan by a self-employed individual can potentially generate tax savings on two different fronts, income tax and self-employment tax. This significantly enhances the net of tax impact of making that contribution and makes it a very efficient way to save for retirement while reducing current taxes.
That dual tax saving income tax and self-employment tax reduction, yeah, that's a powerful incentive for the self-employed to prioritize retirement savings. So ultimately, arming yourself with this knowledge allows you to make much more informed decisions, maybe, as you said, choosing a slightly lower gross return investment that's highly tax efficient over a higher gross return one that's fully taxable. especially if your primary goal is maximizing long-term after-tax wealth accumulation, right?
Precisely. It's really about looking at the long game and focusing on sustainable after-tax growth. The knowledge of these specific tax treatments, how different accounts work, how different income types are taxed, the impact of holding periods, empowers you to choose investments and account types that truly align with your overall financial objectives. It allows you to optimize for what you keep, which is ultimately what matters, rather than just chasing the highest gross number on paper. You might very well accept a slightly lower gross yield if the superior tax efficiency means a significantly higher net return lands in your pocket over the decades.
What you keep, not just what you earn. That's a great summary. This entire deep dive has really underscored the incredibly intricate rules governing retirement plans and investment income in the U.S., but also really highlights the importance of maybe the less glamorous side, formalities and compliance. Why does having that written plan document matter so much for qualified retirement plans, for example? Seems like bureaucracy, but you said it's fundamental.
It is absolutely fundamental, yeah. For qualified retirement plans like 401ks, SEP, defined benefit plans, etc., having a formal written plan document that meets all the complex requirements of the Internal Revenue Code and ERISA, the Employee Retirement Income Security Act, is not just a suggestion, it's a strict legal requirement. This isn't just bureaucracy for its own sake. The plan document is the legally binding rulebook for the plan. It defines eligibility, how contributions are determined and allocated, how benefits accrue and vest, when and how distributions can be made, how the plan is administered, everything. It ensures that the plan operates consistently and fairly for all participants, and crucially, that it complies with the intricate tax laws that grant these plans their favorable tax treatment, like deductions for employer contributions and tax deferral for participants. Without a properly written and maintained plan document, the plan simply doesn't qualify for those tax benefits, which could have disastrous financial consequences for both the employer and the employees. It's the foundation upon which everything else rests.
Okay, so the written plan is the non-negotiable foundation for tax benefits. Got it. And it sounds like all those various IRS forms we've mentioned throughout this deep dive, the W-2s showing deferrals, the 1099s for interest, dividends, OID, distributions, Form 50329 for penalties, Form 8949 for capital gains. These are essentially the practical interface, the way we report and ultimately understand our personal tax situation related to all this.
That's a perfect way to put it, yes. Those forms are the official roadmap and your permanent record for tax purposes. They translate all these complex rules and transactions into a standardized format that both you and the IRS can understand, or are supposed to understand. Your W-2 shows your compensation and retirement plan contributions. The various 1099 forms report the different types of investment income you received. 1099 INT for interest, 1099 DIV for dividends, 1099B for brokerage transactions, 1099-OID, 1099 II for distributions. Form 89, 49, and Schedule D are where you calculate and report your capital gains and losses. Form 5329, as we discussed, handles those additional taxes and penalties. Understanding what each box means on these forms, reconciling them with your own records, and reporting them accurately on your tax return is absolutely critical. It's how you communicate your financial reality to the IRS and ensure you're meeting your tax obligations correctly. They are the tangible link between your financial activities and your tax liability.
The tangible link, yeah. And staying vigilant is also key, right? Especially in avoiding those prohibited transactions we talked about and just generally understanding the penalties for messing up.
Absolutely. Vigilance is crucial. The penalties for things like making excess contributions and not correcting them, taking early withdrawals without a valid exception, or failing to take your required minimum distributions on time. They can swiftly and significantly erode the tax benefits you've worked so hard to build up in your retirement accounts. And being acutely aware of what constitutes a prohibited transaction, like borrowing from your IRA or engaging in self-dealing with plan assets and understanding the potentially severe consequences is paramount. It really means being proactive in managing your accounts, understanding the rules that govern them, and seeking clarification if you're ever unsure. Ignorance, unfortunately, is generally not an excuse when it comes to these tax rules.
Yeah.
Got to be proactive and understand the rules. Okay. So we've done a very, very deep dive into these rules today, covering a ton of ground. It's also really important to acknowledge that every single individual's financial scenario is unique. What advice do you have for our listeners when it comes to applying all this information to their own specific situation? And maybe reiterate the value of getting professional guidance when needed.
That's a really important closing point, yes. Because while we've covered the general landscape, the specific rules, the common scenarios, your unique financial situation is exactly that, unique. Your income level, your filing status, single, married, filing jointly, etc. Whether you have access to good employer-sponsored retirement plans, your tolerance for investment risk, your time horizon until retirement, your expectations about future income and tax rates, all these factors play a significant role in determining the optimal strategies for you. It's a highly personalized equation. So for specific questions or to delve deeper into how these rules apply to your particular circumstances, always refer to official IRS resources first. IRS.gov has a wealth of information, publications, forms, instructions, FAQ, even interactive tools like the Interactive Tax Assistant, ITA, that can provide authoritative answers. And critically, while the IRS emphasizes that you are ultimately responsible for the accuracy of everything on your tax return, seeking qualified professional guidance can be invaluable, especially when dealing with complex retirement planning and investment taxation issues. A qualified tax professional, like an enrolled agent, EA, a certified public accountant, CPA, or a tax attorney who has a thorough understanding of these intricate tax matters can help you navigate the complexities, ensure compliance, and make the most tax-efficient decisions tailored to your unique situation and goals. Think of our deep dive today as providing you with the essential knowledge, the map, and the understanding of the terrain. A good tax professional can then help you plot your specific personal route through that terrain.
What an illuminating journey. Seriously, we've navigated the really intricate world of U.S. retirement plan taxation and investment income rules. It's dense stuff, from understanding how compensation even affects your ability to save, to choosing between traditional and Roth accounts, SEP versus 401k, and then decoding how different investment gains, losses, dividends, interests are taxed. We've truly seen how every dollar saved and invested has its own unique tax story. The real deep dive, I think, is understanding how all these rules ultimately shape your net financial outcomes, what you actually get to keep and grow, not just the gross figures you might see on a statement. It's really about keeping more of what you earn and letting it compound more effectively over time by leveraging these tax rules smartly, truly making your money work harder for you in the long run. So, here's a final thought for you, our listener, to mull over. As you continue to build your financial future, remember that true wealth isn't just about how much you earn, but how much you keep after taxes and inflation. What new chapter will you write for your money now?
And how will understanding these intricate tax rules, the nuances of retirement plans, the treatment of investment income, empower you to shape that narrative, your financial story, towards its most prosperous ending? We really encourage you to take this knowledge and revisit your own financial strategies. Maybe ask some new questions, consider some different approaches. The journey to being well-informed, especially about taxes, is definitely continuous. But your financial future will certainly thank you for taking this deep dive with us today.